We're going to start off looking at 6 key indicators as indicated in the lower right-hand corner. Then we're going to move on and look at 3 distributions. These are for time to sell, sellers ask price reductions, and buyers overbids. Then we're going to talk about metrics, graphs of the data for all of Silicon Valley. Then we're going to compare the 3 counties in Silicon Valley, Santa Clara, San Mateo, and Alameda County. Then we'll finish up with the 20 micro market areas up here in the upper left corner. And finally, at the end, we go over the Greater Bay Area, which is 13 counties in 5 regions. It lasts about 35 to 45 minutes, and let's get into it. Here are the 5 key indicators. The first one is inventory. This is 14 weeks of data, so we're going back 13 weeks inclusively. You can see that at 13 weeks ago, a quarter ago, we were basically here on the red line. That indicates we had the least inventory you'd expect. We had a gradual growing up of that inventory almost to normal here. And then it basically has followed the normal trend. So we have almost normal inventory. We're a little low. We should be at about 87% of the inventory you'd expect. The gray line is where you'd expect every indicator to be. The blue is always favors the buyer. In the case of inventory, that would be a surplus of inventory. And the red always favors the seller, which would be a lack of inventory. Flipping over and looking at the number of offers accepted, you can see, again, we started the quarter, and this is a moving quarter. So it's March 29th of 2024. You can see we basically had the least number of offers that you would expect at 69%. We have followed the trend. We actually went below for most of the moving quarter. And the last 4 weeks, we have been falling right at the minimum that you'd expect. And we right now have 81% of the number of offers. So if you have 81% of the offers you would expect and 87% of the inventory, you clearly are not in a marketplace that is restricted by the lack of inventory. The number of inventory would have to be lower than the percentage of normal for offers in order for it to be potentially in an inventory restricted marketplace. Then we're looking at the supply demand ratio. So it's actually the seller buyer demand. And you can see that in this case, a low number is actually a faster paced market. At 89% of normal, you can see the gray line was right up here. And we were actually on the hot side of the market. So the market was moving more quickly than it typically did, even though there was a lack of offers and a lack of inventory. And you can see in this case, at the beginning of the moving quarter, this is basically 69%. That's basically 72%. So they're within 3%, and they're both on the low side, but they were slightly worked out such that the days of unsold inventory, the speed of the marketplace, was slightly favoring the seller. Now, keep in mind, all 3 of these indicators are independent of each other. In other words, I'm looking at the inventory independent of everything else for the past 10 years, offers independent of everything else, and the days of unsold inventory independent of everything else. So there can be a little fluctuations. Now you can see that you were basically, for most of the quarter, you were above the normal line and on a little bit on the cool side. And that's where we are now. We're 113%. So you have 13% more days of unsold inventory than you typically do at this time of the year. More days of unsold inventory favors the buyer, and that's why it's favoring on the red line. Then we're moving on to days on market. This is the long typical time for the seller to sell. And you can see that at the beginning of the quarter, we were very close to the record low numbers, and record low is 90 percentile. You can see we've basically been trending, but the last couple of weeks, we really broke away. And this week we're at 100%. So we're exactly at normal. Now it's only an increase of 2 days, but the bigger change is you went from 79% to 100% of normal. So you went from a faster than normal marketplace to an absolutely normal marketplace. And most of that change happened in the last week because, from here it's pretty close, here it's pretty close, and now you're all the way up to normal. Now these scales are pretty tight, so it's really hard to get a good estimate, but it gives you an overview. And the reason I put the thin color lines is real estate's very cyclical, and a line going up or down doesn't mean anything. You need to know where is it going up at a faster or slower rate than it typically does. Now we're looking at sellers ask price reductions. So these are expectations of the sellers versus reality. The seller has certain expectations when they go on the marketplace. If they have to reduce their price, their expectations exceeded the marketplace. And you can see that we started off with 0.3% reduction, which may not sound like a lot, but because the vast majority of the sellers are reasonable people and do their research, what turns out to be is only a very small percentage of the sellers reduce their price. So this 33% was actually 69% more price reduction than typical. If the number was somewhere around 0.2% price reduction normally, and it was at 3.3, that is about 170% more than normal, because 50% more than normal would be 30%, and half of that would be 40%, 0.4%, and you're somewhere in between when you're at 69%, because halfway would be 75. And then the big takeaway is over here, you can see that we're cooling down. And again, that cooling down has been basically in the last 2 weeks. Here, 2 weeks ago, you were pretty close to the normal amount of price reductions. Last week, there was an increase, and I would say there was an increase here. But keep in mind, look at how much the blue line falls off at this time of the year. This is basically entering the cooling off period, and we have definitely entered into that cooling off period. And so sellers tend to look in the little rear view mirror. The whole industry tends to look in the rear view mirror a little bit. And so now they've been on the marketplace, they're not getting the offers, and there's an increased number of people that are doing price reductions. So now you're at 0.9% price reduction, but that's actually a lower percent increase. It's only 40% more than normal decrease than back here when it was 70. So back here, there's very little decrease going on. So a 0.33% reduction is 70% more than typical. Here, and 0.9% reduction is 40% more. May not sound like it makes sense, but it's because the normal drops off fairly significantly, and even the typical, and the percentages are based on typical, so I should focus on that. Even the typical was way up here, and now it's down here. And the last one is a time delayed indicator, and this is the competitiveness of the marketplace. How much are the buyers feeling the pressure when they're coming in to make an offer? And you can see it started off pretty aggressive. You were above. We got the peak aggressiveness was right through here just about 7 weeks ago, plus or minus a few. But now again, in maybe the last 3 weeks, the buyer competitiveness has been dropping off. Keep in mind, this is where the market was 4 to 6 weeks ago. So you take 4 to 6 weeks ago plus 3 weeks ago, you're now 7 to 9 weeks ago is sort of when the buyers started feeling less pressure. Now we're looking at the whole marketplace, and by the whole marketplace, we're talking about Silicon Valley, we're talking about Santa Clara County, San Mateo County, and Alameda County. The purple line is inventory. You can see inventory dropped compared to where it normally is over the last week. Normally you're up here at 100%, which would be that those gray lines all stretched out. And in this case, inventory went from 92% of where you'd expect it to be down to about 86%. So you've actually had a drop in inventory compared to normal. Your offers have been basically flat, and your offers are flat at about 79%. So you're having 79% of your offers, which is a lower percentage than your inventory, causing your days unsold inventory, the ratio, to be higher. And that's at about 113.5% of where you'd expect it to be, or 13.5% more than you expect. Now we're looking at our first distribution. Here, what I look at is every transaction over the past 5 weeks. In this case, it's offers accepted, so that you don't have the lag time waiting for escrows to close. And we're simply looking at how long did it take those sellers to get an offer accepted. Blue dotted dashed line down here is a year ago data, and that's where we're going to start off. But on the first and last slide, I also put the current data, the purple line. So you can see that the market's cooler now than it was a year ago. So it's taking sellers longer. For example, 75% of the sellers sell currently in something like 22 days. And then a year ago, it was something like 17 and a half days, maybe right in that time frame. So it's taking the 75th percentile, the long typical seller, 3 days longer to sell their home this year than they did last year. Don't get me wrong, 21, 22 days is still a fast marketplace, but we need to compare everything to where the market is, because Silicon Valley doesn't compare to any other real estate market, a place that I'm aware of anywhere in the United States. So anyway, you start off on the blue dash dotted line here, and you step through a week at a time, and it's a month at a time roughly, in which is 4 or 5 weeks. You can see you're bouncing around. Now you're starting to slow down, real slow down. That's sort of the slowest marketplace. Now you're in January 24th, an improvement, huge improvement a month later, and now you're shifting over to weekly data. And you can see that we bounce around here, and the peak of the market's right about there. That's about the lowest you get. And now you can start seeing that the line each week is sort of moving up. There's a little bit of bounce initially, but now watch that one. See how it's moving up into the left fairly significantly now each week. So this is again the current week. So this is the current week. The hot week was way down here. This orange dashed line down here. The lowest line across there would have been the hottest marketplace. And that was back here on April the 26th. So we've been actually slowing now for 2 months pretty consistently. The slowdown was a little plateau initially, so you're sort of at the plateau on the peak of the marketplace, and now we're in the part where you start slowing down. Keep in mind, a year ago, I was jumping a month at a time, and now it's only a week at a time. So you're not going to see those big increase in days on marketplace until you get back to things like July 26th, which is, and that didn't happen right away. It basically happened on probably September 27th would be my guess. So we still have, a good 3 months where the market is going to be fairly quick. And in Silicon Valley, the market's always quick, because even if you come up here to say one of these slowest lines, 75% of the sellers were selling their property in 40 days. That's under a month and a half. It's it's a month and a week, 5, 6, close to 6 weeks. Most people would be happy in the US to sell their home in 6 weeks. Now we're doing the same sort of thing, but we're looking at the seller price reductions. And again, this is where the seller's expectations were compared to the marketplace. A year ago, which is where we're going to start off on the blue dash dotted line up here, sellers' expectations were more in line with the marketplace, so there wasn't as much adjustments. Here now, the sellers have higher expectations from the market. Therefore, they're taking more price reductions, because down here, down and to the right, is the coolest marketplace. The blue dash line down here is the coolest marketplace, and it's hard to see on the left, but right at the top of the screen, right along the 0 price reductions, is where the peak of the marketplace was. Because if you go back to the hottest week we actually had, we had a small percentage, and it was somewhere around 2%. So just off where I cut off this off at 2.5%, the most aggressive sellers were raising their prices. So now let's step through, which now remember, you're starting off on the blue dotted dash line up here. You can see you're slowing down, bouncing a little bit. And now you're going to probably start right there as a start. That's the end of the year slowdown. Now you're getting into the beginning of the year pickup. And now you're going to have big steps. And again, you're going to see the peak of the market, which is going to be this blue dash dotted line up here, right there, which is February 19th. And that actually is interesting because, that ties in really closely with the first slide we looked at, which was April 26th. This is April 19th. So sellers were starting to take their price reductions before they were taking longer to sell. I would have actually expected the reverse, but that's an N of 1, and you don't set trends based on an N of 1. You need at least 3 to have a pattern, and you want a history of that behavior before you call it a pattern. Moving on to the overbidding. So now we're looking at what the buyers are feeling. How much are the buyers feeling pressure to buy the house? Again, the blue dash dotted line down here is where we were a year ago. And in this case, the current data, the purple blue dash dotted line up here, is actually better, a hotter marketplace. So buyers are overbidding more, even though the market on the other 2 metrics was cooler. Why is that? Remember, a year ago in 2023, we had just come out of probably one of the most rapid, most significant price declines that we saw in the last 3 quarters of 2022. And so anytime you have a reduction, a adverse event in the marketplace, whether it be real estate or outside that impacts real estate, buyers get more conservative. So a year ago, they were more conservative, not because the market was cooler, but because they just went through the correction of 2022. This year, they don't. That's more in the rearview mirror. They sort of forgot about it. So even though the market's slower, they're actually overbidding a little bit more aggressively. So walking forward, you can see you start off at sort of a level plateau right around a year ago numbers, and now you're going to start declining. Right there, January 24th is sort of the worst that's plotted. By March 1st, we were improving. And now we're worried about where the peak of the marketplace is. And I would say it's probably right there, which again was that April 26th timeframe, but it stays up there for quite a while. But now you're going to start noticing right about here, see the decrease. So basically starting June 7th, there was noticeable decreases. But again, if you go back to June 7th, subtract off the lag of 4 to 6 weeks ago, you're back sometime in the April timeframe. So I think from all the data I'm seeing, the peak of this year's marketplace happened right around middle to the end of April. It all depends on how you want to measure the market. In fact, that's an interesting comment. When someone asked me, why aren't I giving advice on when the best time to buy or sell is? It all depends on what the principal wants. They may want the highest price. That's going to be at a different time. They may want the least amount of hassle. That's going to be at a different time. They may have a property to sell. That's going to be at a different time. They may have a property they will sell, but they're going to sell it after they purchase. So everybody's situation is unique. And what the key is, in my opinion, is to tie your personal needs with what the market is. And not everybody's got flexibility of when they buy and sell. So where at the minimum, what the data helps you do is determine whether you want to be aggressive in your price, whether you're a buyer or a seller. Aggressive in a buyer is high, aggressive in a price for a seller is low. You have to look at the data, you have to understand the data and apply it to the individual situation. There are no broad brushes of this is now a good time to sell, and that's why you don't hear them in my videos. We've been talking about the real estate market analytics in Silicon Valley on June 29th. Do like my videos, it does help get more word out. The YouTube, the green down here's my root URL. You can type that in. If you don't want to trust me to take you to this, you can type in the blue YouTube archive, which is an archive of all my sessions. I try to get them up over the weekend. If you want to join the presentation live Saturday morning at 9 o'clock, just add in the year to the root URL, and the green is what I call my root URL. The handout, you add in H, the year 2024, the month 06, the day 26/9, and it is up and posted. I got it up early, got it up just about 8 o'clock, and you can get to any episode directly or by using the link. My contact information, Richard Calhoun, Creekside Realty, is on the bottom of your slide, big here for you. Working with buyers or sellers, single agency here in Silicon Valley for many decades. Moving on to looking at how Silicon Valley, so this is all three counties in a blender, how we do on each metric. So now what you're doing is before January 1st, 2023, you're condensed. So each year, each vertical bold line is a year, the thin lines are quarters. And so you can see the pattern, and that pattern gives you a full year here in 2023. And then you can see where we are now. So this is 2024 data. You can see that we're approaching the normal, but we're still less inventory than you'd expect. And we have somewhere around 25,750, maybe closer to 25,075 listings on the marketplace. So you have a little bit of a shortage because you normally is going to be up here, but you're sort of following the trend. The inventory really came up starting on April the 1st and started really growing. And then basically the last couple of weeks, it's been more parallel to the gray line. So you learn quite a bit by showing these trends. What you'd expect it to do is you'd expect it to continue to follow sort of the normal trend at this point. So I'd expect inventory to continue to go up until somewhere around the middle of July. So if you're a buyer that wants the most choice, that's a good time to be out looking. It may not be a good time to be buying from a point of view of appreciation, because now you have to wait until January of next year to start seeing some appreciation. But anytime you buy real estate, and I'm a big fan of real estate, I've done very well in real estate, and not only as my income source, but for my investment aspects, it's something that I believe in. And just if you can improve your investment aspect, that's great. But real estate is an emotional family need as well as the investment. And that's one of the reasons real estate's so stressful. That's where we are on inventory. Now what we do is we stretch out the gray line and we look at it, and you can see that inventory actually reduced a little bit week from last week compared to normal. So even though the inventory is up, it's down from where you'd expect it to be. So the increase of inventory from last week to this week is less than you would have expected based on the normal pattern. Here's the number of offers, and you can see now it looks like you're very close to the blue line. In fact, you almost can't see the blue line, but it's a vertical separation. So you're still a little bit above where the blue line is because it's this vertical separation, but you should be way up here. So we should be at about 2,800 homes being sold, and we're only down here at 2,200. So we're lacking about 30% rough numbers. And I think the number was 69% from earlier. So we're losing about 30% of the number of transactions we normally do. One of the things I want to point out is I don't talk about pending transactions, and you'll hear that all the time. There's a major flaw looking at pending transactions, and that's if it's in escrow for 10 weeks, it's pending for a lot longer than if it's in for 1 week. By looking at offers accepted, they all count for 5 weeks. And part of the reason I want to do that is some transactions fail. So if an escrow fails after 1 week, yes, it counted for 1 of 5 weeks, but it had a smaller impact on the data than that offer overall because there was something wrong with the offer. So I believe that it's a much better way to measure the metrics. You want to discount TFTs. You don't want to put a premium on transactions that went for a long time. In fact, I would, if I could figure out a way to do it, I'd want to put a discount on ones that took a long time because there was a trouble with the escrow or something. There was something unusual about it, and it's not reflective of where the real market is. Here again is the same concept where you pull out the gray line, the normal line, and you can see that your offers are accepted are sitting down here at 79% of where they should be. So we're losing, as I said, 21% of the offers. Here's your days on sold inventory. You can see that you're quite a bit above the normal marketplace. The normal marketplace is down here right around 34 days maybe, and you're up here at 40. So you're 6 days longer roughly than you normally are. That's almost 20% longer. You're way down from where your cool marketplace is, and you're way up from where a hot marketplace is. So we're in a cold marketplace. We're on the cold side of a lukewarm being normal. Here you can see the normal line, and you can see that the data for days unsold inventory is higher, which is a slower marketplace. That's why it's shaded blue as it favors the buyer. Here's looking at the long-time typical sellers days on marketplace. And I have spent a fair amount of time in the last 2 weeks looking at this metric. I'm convincing myself I'm probably going to change this to the 90 percentile. That will get me away from the step functions that I don't like so much. And it will give me more swing in the numbers, so it will be more sensitive to the number changing. The debate I'm having with myself is, do I want to look at the mean for the top 90%, or do I want to look at just the 90 percentile? And I'm coming down on looking at just the 90 percentile. So changing the long typical seller from 3 out of 4 to 9 out of 10. So if anyone has any feedback on which number they'd like better, drop a comment to me. Here's the days on market compared to normal. You can see that the market's really slowed down, and that's sort of a red flag. So let's go back and you can see the real increase. So you went from basically the hot marketplace to the cool marketplace, and you did that in 1 week. For whatever reason, the time it's taken 75%, 3 out of 4 sellers to sell has jumped dramatically in just the last week. And by dramatically, it went from, it looks like 14 days to 17 days. So it's a jump of 3 days in 1 week, which is pretty significant. And what really flagged me was this huge jump. You went from basically somewhere around 83%, 82% to basically 100%. So you gained 18% of the market compared to normal. Now we're looking at the seller price reductions, and 0 price reductions right here. Here you can actually see where we were raising prices on average, and that was because a few sellers were raising the marketplace, their ask price. And right now, the purple line is always the current data. You can see that we're quite a bit above the blue because it's the vertical, not the horizontal distance. It's the vertical separation that matters. But you're also quite a bit below the gray line and way below. So this says that sellers are taking bigger price reductions. What do we mean by bigger? Well, they're somewhere right around 0.9% price reduction. I think the number was 0.89 from before. And again, this is the reason these numbers are so small is the vast majority of the sellers take no price reduction whatsoever. Here's the slide compared to normal. So it's normal to take a little bit of a price reduction, which is why a hot market goes below the 0 number. I'm also thinking about changing my scale a little bit on this, but I haven't yet. So here you are bouncing around, and basically you're heating up a little bit. So sellers, even though they're taking less price reductions historically until this last week, there was a big change right around Easter and Cesar Chavez's birthday. And then it was basically a trend up. So there's a lot of movement in this data, which is not a good thing because, there appears to be false alarm because the general trend is up like this. And yet you'd have this big decrease this week, but you've had big decreases from week to week. So, that makes me a little nervous that it's not a very good metric. Now you're looking at the frequency of price reductions. So how many sellers are taking their price reductions? And you can see we've been basically following the normal line until last week. So last week, for some reason, more sellers than normal decided to take price reductions, and maybe they're sensing the market slowing. And so you can see the increase here. It's still pretty close to normal because, a slow marketplace would be up here around 20% and you're somewhere around 14%. Here's the same line stretched out. So you can see that last week was a significant improvement. This week is a significant slowdown. That's not the kind of data I like to see. I like to see nice, smooth trends. I'm not sure why the frequency of sellers makes a big difference. And it's logically, if only 15% of your sellers are making a price adjustment, and then 25% more of the 85% that don't make adjustments all of a sudden do, there's a big change. So, that's part of the reason I think it's so sensitive. This is overbidding. This is what the buyers are doing. Now look at how much this has dropped down. So this is the magnitude of the buyers overbidding. Just a couple weeks ago, you were at 8%. Now you're down to 6% overbid. And remember again that this is a lagging indicator, because to know how much the buyer overbid, I need to know the sale price. So I have to wait for escrows to close. So that's that 4 to 6 week delay, which is why I focus so much more on offers when I possibly can. But knowing what buyers are overbidding is consumer interest point, and that's why I follow this data point. Here's the same concept where you stretch out the line and look at the decrease from last week. Last week, you were basically 2%, maybe 2.5% more overbidding than you typically do. And now you're down to 1%. So you lost 1.5% in basically 2 weeks back here. But that's still a pretty rapid drop. As you can see, buyers are sensing the market is cooling. Here's the overbid, the frequency of overbidding. And again, this number is cooling. The frequency of overbidding does not drop as rapidly as the magnitude of overbidding. Buyers are willing to overbid. That doesn't change as rapidly, but the amount they're willing to overbid does change more rapidly. Here's the frequency, and you can see the drop. You're getting closer to normal. Again, you've had this drop. I would say this was a 1 week drop. Clearly, things changed 4 to 6 weeks ago, plus a week ago, and even more, probably further back than that. And it's showing up in the data. Here's your sale price. The slope blue line is a constant rate of appreciation. You can see that prices have rolled over and have started to come down now just in the last couple of weeks. There was a long plateau. We had one bump up week, and now we're coming back down. Here's the estimated payments, and these use the interest rate, Freddie Mac interest rates for the national average. And that did come down again a little bit last week. It's basically flat. I think it was 6.89 if I remember the number correctly. But I go through a calculation. This shows that the cheapest 10% home would have a monthly mortgage payment of about $7,000. The typical home would have a mortgage payment of about $13,000. And the most expensive, if they got an 80% loan, which would be pretty unusual, would have a mortgage payment of about $27,500. The big takeaway here is the number of offers, and you can see that we have the 8th lowest week. Right now, this week, we did 2,206 offers. That beats out 1,900 and 2,168 from 2 years ago. Now, I will point out that last week, we also were at the 8th week because 2,281 was a higher number, but now was a lower number, but because of TFTs, we're now down to 2,277. I don't remember what the number was, but I do remember that last week this was 8, and that's a live database, and I update it for 13 weeks going back. I'd update for a whole quarter to try to keep it updated. Now we're shifting out and looking at how each county does. Gray is Alameda County, so it's got the most active inventory, and you can see it's typically on top. Santa Clara County has got the next, but Santa Clara is normally closer to Alameda County, and then San Mateo County, being the smallest, has less inventory. But if you just go back, San Mateo County is probably the county that's the closest to its historical level of inventory. This is looking at offers accepted. Silicon Valley, even though it had less inventory, had more offers. So the speed of the marketplace in Santa Clara County is clearly faster than the speed in Alameda County. Alameda County is next on offers, and San Mateo County is the slowest. And if you look, San Mateo County has less offers than it typically does. So it's going to be a slower market than it typically is. Here's your days on unsold inventory. Alameda County has the slowest, up here at somewhere around 46 days. San Mateo County is just over 40. And Santa Clara County is the fastest at 34 days of unsold inventory. Here's the time for the 75th percentile seller to sell. Santa Clara County is the fastest. Here, the two counties, San Mateo and Alameda County, are almost identical. Looks like Alameda County is 24 and San Mateo County is 25. Here's the magnitude of list price reductions. You can see that San Mateo County is doing the most price reductions at about 98.7. So that's about a 1.3% price reduction. Alameda County is right at 1%. And Santa Clara County is at 0.6% price reductions. So this is very small number. But again, the reason it's small is very few sellers take price reductions, in part because the market's so fast and they do their homework. Here's the frequency of ask price reductions. So Santa Clara County, only somewhere around 13.5% of the sellers reducing their price. I can't get an accurate reading of Alameda County, but the Alameda and San Mateo County are both right around 16% of the sellers reducing their price. So that's about 1 in 7 sellers reducing their price. This is the magnitude of overbidding. Alameda County, even though it's a slower county than Santa Clara, has more aggressive overbidding. Then Santa Clara County is almost identical to San Mateo. it looks like their Santa Clara is slightly higher overbidding than San Mateo, which is again interesting. San Mateo County was clearly the slower county, and yet it has as much overbidding as Santa Clara that has the most. And that's again one reason you want to look at the marketplace. Normally you'd assume overbidding magnitude would go along with the speed of the marketplace, but clearly it's not the case. Here's the frequency of overbidding. Overbidding frequency in San Mateo County is the least, which means the transactions that are overbidding have to be overbidding by a greater amount than the transactions in Santa Clara. And in this case, Santa Clara and Alameda County data frequency of overbidding is roughly the same at somewhere around 76%. Here's the long-term appreciation. Here, Santa Clara County is the clear winner with the highest appreciation at somewhere around 105% appreciation. Alameda County and San Mateo County are right neck and neck at about 80% appreciation. I'm using my benchmark of the last 9 months of 2015, so it's the long-term appreciation. And if you come back and look at the left of the graph, you can see the orange line was right in the center until we get to the pandemic, and then boom, fairly quickly, it ended up at the bottom. And then in 2023, it's clearly on the bottom, and it's doing a little bit of recovery now. Now you'd almost have to say Santa Clara is the pull away. Here now is looking at the median sold price. You can see all three counties went down a little bit. They're basically getting close to, but now again below their peak of 2022. So if you bought right at the peak of 2022, and if your house was representative based on the median, which may not be true, you'd actually be upside down again. Here is the same information on regular paper for those prefer. You can see a little bit better the separation between Santa Clara County and San Mateo County. San Mateo County being almost 2,100, which is 2,100,000. And Santa Clara County is about 1,950,000 roughly. Here's looking at the estimated payments. They're going to be in the same order because it's a mathematical formula that gives you the payments. Here's the raw numbers for those that prefer. You can look up Silicon Valley as a whole, Santa Clara County, San Mateo, or Alameda, and the different metrics here. It is interesting the number of new listings is down, but the active inventory in Santa Clara County is up. It's down in the other two counties. Clearly a shift. The offers are down. Then you come down and look at the days unsold inventory up in Santa Clara County, but level in San Mateo and down in Alameda County. So you can see that the three counties in Silicon Valley are not moving lock, stock, and barrel, and they never do, which is one of the reasons I got into micro markets, and that comes up right now. Here are my 20 micro markets. I had to do a change because of the vendor I use. I'm now, instead of using letters, I'm using numbers. So the teens are Santa Clara County, the 20s are San Mateo County, the 30s are Alameda County. I would prefer, and I could go back to letters, but once I thought of dividing it up, I thought you, the listener, may prefer the teens, the numbers, so that you can quickly see what county you're in. I'm open for feedback on whether you want this or numbers. The reason I don't like numbers is they're confusing with the actual data to some degree. And at the bottom, the 40s are my metric. So right off the bat, what you can do is basically see there's normal inventory. There's a shortage in sort of the center of Santa Clara County and a shortage in the Bay cities, but most of the other areas are about normal. By about normal, it's plus or minus 12.5% of normal. So from 87.5 to 112.5% would have no color. Here's the number of offers. Now this has color and it's blue favoring the buyers. So that means there's a lack of offers. The areas that don't have a lack of offers is sort of the expensive areas in Santa Clara County. They're having roughly the normal number of offers. And, it's not hugely normal, but, 109%, 108%, 98%, that's a lot closer to normal than 80s and 60s and 70s. Here's the speed of the marketplace. Now you got a little bit of a balance, but, here red would be a hot marketplace in Saratoga, Los Gatos is the hottest. Palo Alto's probably second. Then some of the slow areas are Redwood Cities, North San Mateo County, and South County. Here's the days unsold inventory, again, an indicator of speed. This is, just how long does it take to sell all the existing inventory if the existing rate of sales stayed the same. Fremont appears to be the hottest, and the Bay cities appears to be pretty warm. Here's the time for selling that 75th percentile. You can see that Fremont, Alameda County is pretty hot. And so is Santa Teresa area, Blossom Valley area, and Milpitas is one micro market area. Moving on to seller ask price reductions. These are getting a little bit more common, and you are seeing some areas of blue.
that in general is anything above 1%, 1 to 5%. And obviously there's no cap to where the amount of the price reductions are, but 5% is where I cap my concentrated blue. So you can't get any higher than 5%. The highest area that I am seeing is the San Mateo County coast, which is sort of the slowest area at 3.7%. This is a very tight metric. In other words, there's not much of a change in it. And that's because the vast majority of the sellers do their homework and price their home correctly. And on top of that, if 3/4 of the sellers are selling it within 3 weeks, they don't even have time to really do a price reduction. But neutral in this case is anywhere from 1/4 to a 1% price reduction. This is the frequency. The previous slide was the magnitude. This is the frequency of price reductions. You can see in the San Mateo County coast, it's 43%. That's actually may not sound like that much. It's less than half, but you can see that I go saturated red at 33%. So this is more of the sellers taking price reductions than I would expect. And it's the only area that is blue in color. Most of the Silicon Valley is red in color. There are a few areas that are neutral. You can see that this Oakland area has a very small shade of blue to it. It's at 21.3%, and you can see the blue starts at 20%. Also, Pleasanton has an even lighter shade of blue because it's at 20.8%, 0.8% of blue coloring to it. Moving on to magnitude of overbidding. This now is what I would consider to be a very lagging indicator. The reason it's lagging indicator is buyers go in, make their offer, escrows have to close before that sales price is released. And for the bulk of the transactions, that's 4 to 6 weeks. So the closings that are happening now are the contract was negotiated 4 to 6 weeks ago. And because I look 5 weeks rearview mirror to get enough data points, you're now looking at something that's 9 to 11 weeks old of when some of these conditions were negotiated. So this is going to be a lagging indicator. You can see that the bulk of the valley is still pink in color or shade of red in color. There are no areas that I am noticing that are blue at all. Moving on to the frequency of overbidding. So how common is overbidding? And here you can see the map is pretty bright red. Most of the areas are getting pretty deep red. The only area that's sort of pale is the San Mateo County coast and the expensive areas in San Mateo County. And they're pretty much neutral. Although if you look at the coast, it's actually a small shade of pink. So even though it's an area that's taking a long time to sell, with 52% of the sellers getting more than their asking price, I consider that to be a little bit in favoring of the sellers. More than half the sellers are getting above their asking price. And the same goes with the South County area. The highest area in a balanced marketplace is the expensive areas, and it's at 46%. This is the appreciation. I selected the last 9 months of 2015. I was looking for a year period of time where prices were pretty stable, and I could not find it. You want stable prices because that way it doesn't matter how the market shifted on some of the homes selling at the expensive time or not. So the most I could come up with trying for a year was 9 months. I used 9 months of 2015. That's basically April 1st through December 31st of 2015. That's my benchmark. You can see the San Mateo County area is all blue in color, and I believe that's directly related to the pandemic. People are leaving the congested areas close to works, job centers, for the more remote areas where you've had the higher rate of appreciation. And you can see that areas are almost directly correlated. The further you are away from the historical job centers, the more red the color is. And typically, because of compounding, whatever areas had the most appreciation recently has the highest overall appreciation. I'm only looking at the long-term appreciation in this slide, basically 10 years worth of appreciation at this point. And on sold price, instead of just following the median price, which gives you some idea where the middle of the market is, I sandwich that with the cheapest 10 percentile as well as the most expensive 90 percentile. So using South County as an example, you can see that from basically $875,000 to $1.4 million, there's 40% of the homes are in between that range because it goes from 10% up to 50%. So in a range of about $5,000, there's half the home, 40% of the homes. But now to go for the next 40%, you have to go up $800,000 from essentially 1.4 to 2.2 million to cover it. The good advantage of this is it gives you a range. You know at what the price range is in every micro market, all 20 micro market areas. 80% of the homes are between those two numbers. So if you're trying to find $1 million home and, you want single family homes, yeah, you're gonna find a lot in Hayward and Oakland, but and even Dublin and Livermore, but you start getting into the other areas and it becomes challenging to find a home for $1 million. And you can find out how challenging it is just by how, like for example, down here in Berkeley and Alameda, the island, there's less than 10% of the homes selling for $1 million or less. And it's going to be less than that because there's going to be a lot of sales right at $1 million. So the fact that this is 9,000 over just gives you an idea that, there's going to be a whole bunch of homes right at $1 million. So it's going to be almost impossible to get a home below $1 million. The same with North San Mateo County coast. And then it gets even worse when you start getting up into Atherton and even Los Altos and Palo Alto with almost, $2.5 to $3 million for the cheapest priced home in that area. Here's a summary of what we've been going over. The first two metrics, in my opinion, really doesn't give you any indication of what the market's doing. Because if you have a lot of offers and a lot of inventory, you could have either a slow or fast marketplace, depending on how they are in relationship to each other. That's why the first one that is giving you an indication of what the market's doing is days unsold inventory compared to the 10-year median. There's a cycle for Silicon Valley, and when you're looking over the past 10 years, that cycle is pretty well built in. So is the current year slower than typical, as indicated by blue? And you can see Redwood City is one of the deepest blues. The absolute deepest is the North San Mateo area. That would be things like Daly City and Colma. There are areas that are pink. Los Altos, Saratoga is sort of a surprising one, and Los Altos and Palo Alto. But then you move on to days unsold inventory, days on market, ask price reductions, and both magnitude and frequency. So these are the current best indicators, in my opinion, of how the market is performing today. Lagging indicators in the orange, as I mentioned before, are lagging because it takes escrow 4 to 6 weeks to close, your long-term appreciation and your current price range. And this column over on the far right is showing you the monthly payments, assuming an 80% 30-year fixed mortgage. Obviously, you can lower the payments by putting more money down or by going in with an adjustable loan, or even a mixture where it's a 7-year fixed and then an adjustable. Leaving the Silicon Valley, moving on to the Greater Bay Area, which includes the cities, North Bay, Central Valley, and the Central Coast, in addition to Silicon Valley. Here are the numbers for those. So you can look at whatever metric it is that you consider to be most important, and then you can see what the metric is in all 13 counties. You can also, because the media focuses on the Bay Area 9 counties, I have that on there. I think it's a completely garbage number. And the reason I believe that is, as you can see, each area within a county, as well as each county, has its own cycle. So when you do it, you have a blended thing and garbage in, garbage out type of situation. I think at the very least, you need to be looking at the micro market areas. My goal is to focus on Silicon Valley, which is why there's only micro market areas for the 3 counties. Here you can see that Silicon Valley is coming up in its inventory. It's getting close to its previous typical. You might call the previous typical somewhere around 3,000. And right now it's some number right around 2,600. So you're within, a little 15% of where you typically are. North Bay up here is doing pretty well too. It's definitely still slower. It's at 3,000, and its normal would be up here almost at 5,000. It has less inventory relative to Silicon Valley. And probably the area that has the least inventory relative to where it normally is in Central Valley, because it now is below North Bay, and the North Bay and the Central Valley have been very mirrored of each other, having roughly the same level of inventory. Now there's a difference of 300. And I'm, going back before pandemic and even after pandemic, the biggest difference I'm seeing is right through potentially right here, and that's 100, 200, 300. Basically, this is tied or exceeding the biggest separation between them. Now, on a percentage basis, this is probably a bigger separation because the numbers are lower. Here's looking at the offers for the past 5 weeks. You can see Silicon Valley has the most offers, and you can see the trend is downwards and fairly significantly. All 4 other regions are still in the upwards directions. So the current reduction of offers is basically hitting Silicon Valley the hardest, and the other areas are still seeing increasing numbers. Days unsold inventory, the fastest is Silicon Valley, but notice how it's been climbing, and at the same time, the cities has been going down. You might call Central Coast a variation because of this one anomaly, but if you look at the trend coming back to this data point, and that data point, the trend is down. The North Bay, the trend is down. The cities, the trend is steeply down, and the Central Valley, the trend is down. And again, Silicon Valley is bucking that trend and going up. And in this case, an increasing number of days on sold inventory as a slowing marketplace. And it's not insignificant. We've gone from basically somewhere around 30 days on sold inventory to 40 days, an increase of 10 days. And we've done that over the span of 1 quarter. Each one of these thin vertical lines is a quarter. So the end of first quarter, end of second quarter, end of third quarter, end of fourth quarter. Here's now looking at the 75th percentile days on market. You can see that all 5 regions are going in the upward direction, with Silicon Valley being the fastest. Slow, surprising, North Bay is the slowest, and the others are pretty close together. Here's now looking at the price reductions. Look at these price reductions, and now remember up here, this is 100 is 100%, so that would be no price reductions. This is a 1% price reduction. You got Central Coast doing a 2% price reduction. You got the cities doing a 1.8% reduction. North Bay is at 1.6. Central Valley and then Silicon Valley are doing the best, and they're basically somewhere right around 0.9% reduction. But these are all sloping down, and the way this is plotted, sloping down is an increase in price reductions. This is on average. So it could be just more frequent price reductions, but it's probably a combination of more frequent and larger price reductions, and all 5 regions are doing that. Here's the frequency. So now we have half the equation answered. Notice that all 5 regions have been going up since basically the beginning of second quarter. Yes, maybe it's a couple of weeks after the beginning of the second quarter, and that's probably reasonable. And that ties in very nicely with my observations earlier, where the peak of the marketplace was either April 19th or April 26th, depending on what metric you want to be looking at. Yeah, I'd have to be in Excel to actually get the date, but for the cities, it's basically the first week in the second quarter. I would say Central Coast is probably 2 or 3 weeks. North Bay is probably 3 or 4 weeks. Cities or Central Valley is roughly the same. And Silicon Valley might be the furthest out and maybe approaching 5 or 6 weeks, but still all fairly close together. They're all going up, which clearly indicates the market's slowing. Moving on to looking at the overbid. So again, now this again is that information that lags behind because we needed escrows to close, but basically all 5 regions are in the downward direction. If someone wanted to argue and say Central Coast is flat, I wouldn't disagree. Central Coast is a smaller area, and so you see more bounce. You can see there's a lot of up and downs throughout the whole graph. You try to get the line to be nice and smooth. The larger your sample size, the easier it is to get the smooth graph. So the frequency of overbidding was increasing in the Central Coast until probably last week, and then it reversed direction and went down. All the other regions were going down for a longer period of time. If I was to pick it, I would say the first one to drop was the cities right here. The second one was probably, I would actually go with Silicon Valley, then probably Central Valley, then North Bay, and finally Santa Cruz. So right there, the timing of all the different regions is different, which again is, and since 3 of the areas being the cities, the North Bay, and Silicon Valley are all make up the 9 counties that touch the Bay, since their timing is different, putting the 9 counties in a blender and commenting on what the 9 counties are doing is not reflective of what any one particular home is doing. Here's your long-term appreciation. The big takeaway, as it has been, is the cities down here in the orange used to be in the center of the pack, and all of them used to be doing pretty well. We hit the pandemic, and then the orange went down to the bottom, and the Central Valley went up. What's that really saying? It's saying people are willing to commute further out to the Central Valley as a result of remote working, as a result of the pandemic. People aren't willing to pay the premiums for living in the cities, and the area with the overall best appreciation is Silicon Valley, but close on its tail is the Central Coast. Again, a more remote working site, because there really isn't that many jobs in Santa Cruz and Monterey counties. Here is your sold price long term. You can see that they're all going up. You can see that they've rolled over. I would argue that the cities has been flat but now is in the downward direction. Same with Silicon Valley, flat and now in the downward direction. Central Coast is still probably flat and not in the downward direction yet, but probably going that direction. North Bay, it was clearly increasing. Now it's going in the downward direction. And Central Valley, it's clearly hit its plateau and it looks like it's rolling all over and going down. I wouldn't want to call it going down, but I think with the other indications, that's most likely what's going to happen next. Here's the payments that are going to be in the same order. You can see that the cities in Silicon Valley are very close together in payments. And again, the payments are rolling over for a combination of two reasons. One, the interest rates have been declining ever so slightly, as well as the prices have been going down. With that, I'm open for any questions. We have been talking about the Silicon Valley real estate market analytics for June 29th. Then we just finished up with the Greater Bay Area, 13 counties, 5 regions. The blue is the YouTube direct archive for those that want to type in less typing. You can type in this green root URL, which will get you to the same place as the longer YouTube channel. You add the purple 2024 to the end of the root URL and you get to the live presentation Saturday morning. I'd be real curious to see if anyone has any suggestions on what day or time that they would be more likely to join me live. I'd like to increase that participation. The handout, you have to add in the H. So the root URL, which is in green, plus the letter H for handout, 2024-06-29. And yeah, it's getting a little bit long, but that way it's a pattern that you don't have to, you remember the pattern and can make it up on the fly. And a specific episode, if you didn't want to go to the channel, you can go to the root URL and put in the year, month, date code, and you get there. I'm Richard Callahan with Creekside Realty, working for buyers or sellers here in Silicon Valley. Please consider liking and subscribing my YouTube channels. I appreciate it. And I'm not seeing any questions, so I will end the meeting. Thanks. Take care. Bye for now.